And since most people use support and resistance, indicators, breakouts, institutions know exactly how to take these people's money. This is why most traders fail. They're entering at the exact spots where institutions are taking the opposite trade. Now, let's compare that to trading with liquidity. When you trade with liquidity, you're not just guessing, you're understanding what actually moves the market, as I showed you a little bit ago. As you start to understand liquidity, you're going to be trading with the actual flow of the market. Price doesn't just move randomly, it moves from one liquidity pool to the next. Once you start to see this, you're going to start to trade like the institutions. Instead of entering with retail traders and getting stopped out, you wait for liquidity grabs. Instead of placing stops where everybody else does, you position them in safe zones where institutions will not target them, which gives you much higher risk to reward setups. Liquidity-based trading allows for sniper entries with super small stop losses and massive upside. Instead of taking random 1-to-1 risk to reward trades, you're catching 1-to-3, 1-to-5, 1-to-10, maybe even a 1-to-15 risk to reward trade because you're entering at these institutional levels. The great thing about liquidity is that it works in all market conditions. Some strategies only work in an uptrend or a downtrend. Whether the market is trending, ranging, or consolidating, liquidity always exists. Big money is always hunting liquidity, which means you always have a framework for finding these high probability trades. The difference between losing traders and winning traders is that losing traders are constantly reacting to the market. Winning traders are understanding the market and even predicting what the market is likely to do before it happens. This doesn't mean that they're always going to be right, but it does mean that when they are right, they have a really high risk to reward trade, and when they're wrong, they just lose a little bit of money. There's three main trade setups that I like to take off of liquidity: bounces, rejections, and break and retests, and we're going to go over all of them right now. The first kind of setup, and the one that I showed you a little bit earlier in the video, is a bounce. We have a level, price comes down to this level, price bounces off of this level and moves up. When we are playing bounces, we are expecting price to move up, which means we're looking for buy positions around these areas of liquidity.